Hello there. I hope that you are doing well. I am Nathan Garcia, and today I want to talk to you about effective versus marginal tax rates. I know that it's not the most fun thing to think about paying taxes, but we're getting close to the deadline for individuals to file their taxes here in the U.S. And as a result, a lot of people are thinking about their taxes and wondering, how can I save some money on taxes? And so in this video, I will share with you the difference between marginal and effective taxes. And when you understand the difference between these two different ways of looking at your taxes, you'll get a better understanding of how the tax system works, but more importantly, how you can save money on taxes. And that can be really helpful and make you more aware of what opportunities you have to save some money on taxes and hopefully keep more of what you earn. So if you don't know who I am, my name is Nathan Garcia. I am a certified financial planner and retirement planning specialist. And I do videos like this just to talk about some topics that I find interesting and that my clients have questions about in an effort just to educate you and just be another resource for you because you probably have some financial questions that you would like some help with. And so in this video, we'll talk about marginal versus effective tax rates and how they can make a difference in your retirement plan. Now, this is just for educational purposes only. The content here isn't considered financial advice for you. And I have to tell you that because I am a registered, I work for a registered investment advisor. And so I don't want you to construe anything that I say here as being financial advice for you. So with that out of the way, let's talk a little bit about marginal versus effective tax rates. So the first thing that we want to look at is your marginal tax rate. Now, your marginal tax rate is the rate at which you pay the last dollar of tax. So here you can see on this table a list of income and the tax rate applied to certain income. So in the U.S., we have what's called a progressive tax system, and the root word there is progress. So the more money you earn, the higher the taxes you pay. And a lot of people think that they pay taxes at the highest rate for any money that they earn. But instead, what happens is for each dollar that you earn, you are going to pay taxes at that specific rate. So if you look here at the table, we have individuals, we have the tax rate for individuals on the left, and then those who are married filing joint, and then you also have heads of household. So if you're just filing heads of household. And you have your different marginal tax brackets here, going from 10% all the way up to 37%. You'll notice that the rate is applied at different levels of income. So depending on how much money you make and how you file your taxes, that'll determine which marginal tax rate is applied to your last dollar of income. And that last dollar of income is really where your marginal tax rate makes the biggest difference, because that is going to determine how much tax you pay on the last dollar you earn. And so most people, they think that if I'm in the 35% tax rate or I'm in the 37% tax rate, then that's what I pay on all of my taxes. And it's just not the case. Instead, what happens is that you'll actually progress through the different tax rates. Your taxes will go up the more money that you make. And when you understand this, you understand what the name of the game is when it comes to maximizing tax efficiency, is that you want to minimize how much money you have available for tax purposes. And one way you can do this is by lowering your marginal tax rate. So going from a tax rate of, say, 35% down to 32%, that can make a big difference for you. And it really makes the biggest difference once you get to determine your effective tax rate. So your effective tax rate is it's how much money you spent on taxes overall. So out of all of the money that you earned, how much of that went to pay taxes? And so the way that you find out this number is by looking at the total amount of taxes that you paid and adding that sum up and then dividing it by your total income. So would you like an example here to help you out? So when we look here, we have a household that has earnings of $315,000. And this is a household that is married, filing joint. So that means husband and wife combined, they have $315,000 of taxable income. For the first $19,050, these folks are actually going to pay a tax rate of 10%. So that means that on the first $19,050, they're going to pay $1,950 in taxes. Now, once they get above 19,050, they are going to be in the 12% marginal tax bracket. So on $58,350, that's how much income is taxable at that 12% tax rate, they're going to pay $7,000 of taxes. So what you notice here is that they go up in taxes because they had more earned income. They went to the next higher marginal tax bracket, and so that resulted in them paying taxes at 12% on the money that they earned between $19,050 and $77,400. The money that they earn above $77,400, so their $77,401 is going to be taxed at the 22% tax bracket. So you'll see here that the 22% bracket applies all the way up until earnings of $165,000 and more. And from $165,000 all the way up to $315,000, these folks would pay 24% taxes. Now, this is all at the federal level, and these are the tax rates, the marginal tax rates from 2018. But what you'll notice here is that when we add up all of the taxes, you notice that there are different rates applied for different marginal tax. Their marginal tax rates have different amount of tax applied to certain earnings. And so when we total it all up, they get $64,224 of taxes. So the last $150,000 that this couple earned was taxed in the 24% tax bracket. So they paid 24% tax on their last dollar earned. That means that they are in a marginal tax bracket of 24%. But if we look at the actual effective tax rate, I actually didn't do this. I should have done this before it came on air. So what you do is you take $64,224 and you divide it by $315,000, and that's going to give you a 20% tax rate. So that means that 20% of their money went to pay federal taxes, right? So their effective tax rate is 20%. Their marginal tax rate is 24%. Now, for this example, I didn't include state taxes. I didn't include the FICA taxes. Some different areas, locales, municipalities, they'll have taxes as well. So if you really want to get a better understanding of your effective tax rate, you want to incorporate all of those different taxes as one. But when you do, you can get a better awareness of how you can save money on taxes. So if you can reduce which marginal tax rate you're in, you might be able to save some money on taxes. So I hope that you found this helpful. And if you did, leave me a comment below, and I look forward to seeing you in a future video. So thanks a lot for tuning in, and I look forward to seeing you in the next video.